Do you want to learn a secret method to double your investment every year? Bulletproof, no error rate, just doubling your money? Then stay. Did you hear such claims on the internet lately? I did, and it worries me. There are so many people on the internet these days who provide not so excellent advice in trading, claiming they know how to make sound returns and become rich quick without any effort. What are the right expectations when investing in private companies, in venture capital funds, or in public companies? These are the questions that I will answer in this video. To get it clear, in this video, I won't show you a secret method because in my opinion, it doesn't exist, but explain what you can expect when you invest in private and public companies. This video contains clips from the All In podcast with Jason Calacanis, David Friedberg, David Sachs, and Chamath. Palihapitiya. What can you expect on the return side? Let's listen to what Chamath Palihapitiya has to say.
Just to give you a sense of it, if you look at the most fantastic organization in the world, if it were an investment manager, which is Berkshire, their long run 50-year track record is, around 20%, right? Gross. If you look at the most successful asset manager in the world, and I would put Blackstone at that, just incredibly good and best in class in probably 3 enormous parts of the worldwide economy: real estate, credit, and private equity. Their long run track record is that on $200 and some odd billion of private equity and another $100 billion of real estate, they've returned 2x. So that's what the upper bound is. Doubling people's money and generating 15 to 20% is the best you can expect if you are really excellent and long lived. That's the best.
Warren Buffett and Charlie Munger are the world's most prominent investors. Their return rate since 1965 is, on average, 20%. In the same period of time, the S&P 500 returned 10.5% annually. What can you expect when you invest in a private equity vehicle or a venture fund or go directly into startup companies?
And by the way, to the extent anybody's listening is able to invest in these private funds, I think Jason mentioned this superficially, so let me just dig into it because I think it's really, really thoughtful what he said, which you should understand. If you have the option to invest in a private fund, you have to understand that that private fund has 2 huge negative things working against it relative to investing in the S&P 500. So you could put your money into a Vanguard ETF, or if you could put your money into a private fund, you need to realize 2 things. Number one is it is illiquid, not just for 10 years, but it could be illiquid for 12 or 14 or in, Friedberg's case, 16 years. So you need to get paid a premium for owning that. And then the second is, depending on the business model, you may have very high failure rates, which means that you need to really hit these outsized Grand Slam home runs. And if you don't, then you're going to be worse off than if you had invested in the S&P 500. So that deserves a premium. And so Jason's right, which is the S&P is between 7 and 8% over long periods of time, predictable compounding. You have to add another 7 to 8% for this illiquidity premium and another 7 to 8% for the business model viability of, for example, being in venture. When you add those 3 things together, you do need to get paid basically in the low to mid 20s returns to be justified. Otherwise, you are much better off just owning the S&P 500.
When we look at the IRR of Chamath's portfolio, it is about 20 to 30% in average. And I'm looking especially on the right side at the line net IRR to investors, which is basically the average return that the investor gets back after all expenses are deducted. So what do the pros consider to be a great return on investment? Let's listen to it again.
The upper bound is, doubling people's money and generating 15 to 20% is the best you can expect.
In principle, everything in the range of 15% to 30% per year is an excellent return on private and public markets. Anybody who wants to sell you a secret method that makes more money in average every year it should probably raise your suspicious level to the maximum. Something is not right there, or it's really an outstanding opportunity like Bitcoin, like Amazon, like Apple, or like Microsoft. But in normal times, investing in normal companies, it's really hard work to make money. And there are a few exceptions to the norm, but they usually are hard to find early. And also they have their ups and downs. When you look at the companies that I mentioned before, Apple, Microsoft, Amazon, or also Bitcoin, usually the highest returns come in very late in the development cycle. And very often you see drawdowns of up to 80, 90, 95% that investors have to live with.
Here's a little interesting data about the ultimate buyer of all of these tech stocks, which is the NASDAQ, right? People that buy stocks in the NASDAQ. Listen to this as of yesterday. More than 45% of stocks on the NASDAQ are now down 50%. So basically 1 in 2. More than 22% of stocks on the NASDAQ are down 75%. So almost 1 in 4 and more than 1 in 5. And then more than 5% of stocks, so 1 in 20, on the NASDAQ are down 90%. So you can use this to actually get a blended average. But what it means is that the ultimate buyers of tech stocks are taking a 60% discount to what they were able to buy even just 4 months ago.
Enjoy investing.